We are on with Garrett and Jesse.
Because you guys got into town when?
I got in Thursday night.
And then Friday was work? What was it, like meetings and stuff like that?
Friday?
Yeah, we met with a couple clients.
Okay.
Sounds
Friday
like you just went out for drinks by the beach.
It's hard to remember now.
Yeah,
that's what I mean, because then it was like they've been like going through Friday night, then
Well,
Saturday.
because we went Friday, then Saturday your event.
Yeah, and then you guys went out. I don't know if you went out afterwards. Then you went to the NFL, the Bills game Sunday, Leafs game Monday.
Yeah.
So yeah, you're on fumes.
Yeah.
We are.
Thanks for being at the event. By the way, we appreciate it.
It was amazing.
You guys helped us out, and we were just talking about it. The fact that I didn't scare the shit out of you with the economic update at the end. Now I feel like I failed because the whole intent is to scare the shit out of everybody to take some action.
I feel like you did.
Oh, really? Oh, okay. Truth is coming out now, really?
No, I said you did.
Oh, did you?
Yeah.
Oh, so it was Jesse who said not really?
No.
Because you've read the Ray Dalio stuff.
I followed Dalio, these big debt cycles.
Got it.
I mean, it's different from all the typical ones you would hear at the conferences. Like the mortgage conferences and stuff. Yeah, they don't go in depth into the history of like trend lines and stuff. So
we don't know. We don't go to any conferences or anything to do with anything. We just put our blinders on and just live our lives.
Like you're thinking, is that better or worse? I think you're debating that in your head right now.
I'm just contrasting.
Bring the mic up to you a little bit.
I'm just contrasting the data and information that was shared at the Rockstar conference versus we were at a Mortgage Professional Canada. I was at a Mortgage Professional conference Canada. And the big economist, Ben Tall, and
he's great.
And the big lenders, he is great. But they were just very much focused on what the mortgage brokers care about, what the realtors care about, which is interest rates and in turn what the housing market's going to do. And it's interesting where you hear these economists say, "Yeah, we'll be at 250 basis point less rate, prime rate." And people are applauding this. I'm like, well, if we're at 250 basis points less prime rate, there's probably big issues in the economy. So like,
what would it take to get it 250 basis points less?
Like we're thinking very
totally
narrowly, not macro. So what you guys did and what we talked about in terms of debt cycles and interest rates and money supply was eye opening, but certainly not a lot of people are paying attention to that.
Yeah. Yeah, weird. For some reason, we've always been focused on that. I think because we thought in real estate, our biggest threat is interest rates. So to understand interest rates at a really good, solid level, we need to understand what's going on around the world because it feels like Bank of Canada basically always copies the Federal Reserve. So then we're like, oh shit, we forget the Bank of Canada. We should just study what the Federal Reserve's doing. And then when you study the Federal Reserve, you're like, oh my God, we need to understand geopolitics and we need to understand all this stuff.
Well, it was when 2008 hit, right? That's when we really got serious about it because that's when we're like, what the hell? Why have we've been blindsided by this? Like what's actually going on? And that's when we started diving into kind of the money system a little bit more and trying to get an understanding. And then when we started going down that rabbit hole, we were like, holy crap. Probably similar to like when you started reading some of Dalio's stuff and you started understanding this, you're just like, what the heck? It feels like you can't, once you see it, it feels like you can't unsee it because it really impacts everything we touch, right?
Yeah, it does. And it's surprising that not more people are talking about it because of what you just said.
Mm-hmm. It is. It surprises us all the time. We're like, why are people just talking about real estate and interest rates in Canada when that's like a second order of effect of what is happening at the bigger level, So it is always surprising.
Everyone's focused, like every real estate article, like it's just focused on prices, like prices today.
Or Bank of Canada and what they're going to do. And we're like, well, the Bank of Canada's actions are a second order effect of what like someone else is doing. So why don't we just go to the source? It does always make us scratch our heads. But I'm sure at Calvert Mortgages, you guys have everything figured out with your analysis on the world. How are
you guys do some good stuff though.
Yeah.
Actually, you showed it to me last time you were here. You guys actually put together some good stuff for people as well. You present that to investors. Is that how it works?
Yeah, we provide economic reports for Ontario and Alberta on a monthly basis. It's narrow, right? We're focused on predominantly the real estate market. So we're looking at employment, we're looking at GDP numbers, we're looking at average weekly earnings, and then specific to markets, what inventories are doing, and in turn, what prices are doing. We're looking at that really carefully because really the thing that we are most concerned about as it relates to a mortgage lender, and we lend really short term, is where we believe pricing trends are headed, and we set our lending standard based off of that. So when we see inventory rising, we might bring down our loan to values in certain markets. So we try to be really nimble.
So are you seeing that net? So in Ontario, inventory is rising in most Ontario market. I mean, I know it depends on property type and market, but in general, it's rising. Are you guys adjusting things a little bit in Ontario right now?
Yeah.
I wouldn't say we're adjusting much yet. Like, it's a pretty balanced market still.
Yeah.
It's not bad. Like, people are still buying flips. They're trying to buy properties under market value, obviously. Usually
Still in Ontario right now.
Still in Ontario, but we're focused on the lower end of the market too. So we're focused on the 500 and lower secondary markets. So that $1 million plus stuff, that's not going to move as fast as that lower end market stuff.
And why, I think I know the answer, because this is how we've thought about real estate for a long time, but why are you focused on that price point in those markets?
More marketable. Yeah, there's going to be more buyers on those lower houses, especially now that interest rates are so high. Yeah.
We've always discussed that the most liquid piece of real estate in Canada is the starter home market. And you can play games in the starter home market. Like, there's the low entry point starter home and there's maybe the high end starter home. But as long as you're in that category, you have the most financing options. You can refinance the easiest. You can sell it if you need to get out. So I guess that makes sense for your risk analysis, that's the area that you'll play in. We noticed that in the 90s. When the market froze up on our father in that example. I don't know if you were in the room, we were talking about our father's example of buying a property at $750,000. People who had starter homes, they still sold them. But the person who had the 5-bedroom, 4,200 square foot, 3-car garage, $750,000 home in 1990, there was no buyers.
Yeah. So these points exactly, there's always a floor that will be established at the low end, right? People can move down, but they're not usually moving up in recessionary times. So on Alberta versus Ontario, where we're at risk-wise, we became more conservative in Ontario back in like February of 22, when quantitative tightening was going to begin, and we saw
when prices were going straight up. Those previous few months, prices literally were going up. I felt like they were going up 20% every month.
Yeah.
It was just ridiculous. Like, you're like, okay, this is a problem.
Yeah.
So that makes sense. That was smart of you guys.
So we're a bit more conservative there. And like you said, with your father, like, we've been essentially a lender in the residential housing space in Alberta for 40 years. And our market gets slapped around basically every 7-8 years with the oil cycles. So Everett, our founder, while he was doing this, and really our success is simply managing risk. So we need to attract good deals, we need to fund them, and as long as we're doing that, we're going to be successful. So the model on short term, mid to lower end of the market, providing capital to those who are providing housing supply for that exact product, which is our flip and burr clients. So yeah, that's kind of a lot of iterations that went into the thinking of our lending standard and of the business model. And luckily the business model works really well because the banks don't want to do what we're doing, which is lending short term on essentially properties that are not currently habitable. And also a lot of our competitors are interested in growing AUM, which is hard to do when we're on this treadmill of funding and getting paid out. But
yeah, what a niche you guys have carved out. Where are you on the Alberta cycle? Where is Alberta on its cycle right now? Don't tell me Alberta's the greatest thing since sliced bread and everything's great with Alberta. Just give it to me straight. Where's Alberta on its cycle? I got to think energy prices in the next decade feel like it's just going to be stronger.
Yeah, but we need they need a government that'll invest in the sector. Yeah. But your provincial government now is kind of behind you. Like, they're looking at doing stuff, but the federal government just refuses to invest in the sector, right?
Yeah, there's not much we can do when the federal government won't do anything.
But is it
like our provincial government's pushing oil and they're trying to get it out there because we're going to need oil for a long time.
So how's
you mean windmills aren't going to power the entire world?
What do you need from the federal government?
We just need them to understand that oil is going to be around for a long time. And the fact that we're taking oil from other countries and we do all our stuff to make sure oil is what am I trying to get at?
So we're dependent on other countries instead of developing the Alberta market so that we can be self-sufficient. Don't we have a lot of oil?
We're some of the cleanest oil, right? Alberta's some of the cleanest oil in the world.
The tar sands?
Over from, yeah. Well, we are comparatively to other countries.
Yeah.
And so
it's the narrative that's been put out there, which is the challenge. And I think where I got really frustrated over the last few years, so I've, knowing different people in Alberta, and, they've been saying this for years, because you guys have definitely been historically more of a boom bust cycle because of the energy industry. And because of some of the laws too, because there's no rent control in Alberta, right? Mm-hmm. So there's no rent control, so you can change rents. But then at the same time, when that happens, when the cycle when the tide comes out, rents can then all of a sudden, drop dramatically too. But they, over the last few years, there's been such a demand for energy, and we even had when, for better or for worse, but with some situations going on, like the war in Ukraine, we had some countries in Europe coming here looking for energy, and we turned them down. I think it was Germany, right? They came in here looking for natural gas, and we just basically turned them down. And then they went and signed a contract elsewhere. I'm like, what's wrong with, what the heck are we doing as a country? It makes zero sense when we're doing that type of thing, when it's going to help, part of the country and the country as a whole as well. It's just, there's no.
Yeah, we clearly don't have serious people running this place. We can just all accept that, and it's just so disappointing.
Yeah, somehow, we had European leaders come and our federal government, I think it was a week it took them to understand that the business case for moving our energy offshore wasn't there yet. In the U.S. over the last decade, the amount of LNG terminals that they've built, and we have more nat gas than the U.S. does, yet we don't have a business of exporting LNG anywhere. We're getting something going we have a small terminal on the West Coast, but anyhow, we're just, for whatever reason, it's become so politicized, and we can't get infrastructure built here in Canada, which is a real shame because it benefits all of Canada. It's not like Alberta profits are staying in Alberta. Alberta profits are being shared throughout our union.
And even without that happening, you guys right now are probably the most kind of the largest real estate market that's on the upswing in the country.
Yeah,
right?
we have a lot of stuff going for us as it relates to that, and we look at it as two markets, right? Alberta's not huge. We're 4 million people, and the bulk of those 4 million people live in the greater Edmonton area and the greater Calgary area. Edmonton is well supplied right now. Edmonton has historically had more lax development rules. So builders, when they see opportunity for profit, they can build with greater ease than in Calgary. So Edmonton is discounted right now, I think about 10 to 15%. Whereas in Calgary, we have a really tight housing market because of our development rules. And we just got a ton of migration coming in. Alberta grew 4% year over year in population through migration last year. It was our biggest growth year ever.
Yeah, we're seeing the people leaving Ontario, they're going to Alberta and on the East Coast too. Those are the two biggest locations that they're they end up, just affordability. And the people that are leaving in Ontario are basically mid-20s to early 30s, that.
The people we want.
That segment of the market, yeah. Because they're looking for a house and they find affordability challenging here. So if they have the opportunity through work or whatever to go elsewhere, they're looking at those.
Are there jobs for all these people coming into Alberta? That's a lot of people to absorb.
Yeah, well, we need to build. We have lower unemployment now than in Ontario. We've always had higher wages, always been producing at a higher GDP per capita. At some point that may break, it breaks fast when energy cycles turn. But right now, energy companies are in as much growth mode as they could be. Unfortunately, we go back to infrastructure and we're still selling energy discounted to the rest of the world. But currently there's work and there's affordable housing. Calgary is still, versus GTA, almost half the cost.
So what's the price of do you know roughly, 3-bedroom starter home, something like that in Calgary?
Our benchmark price right now is around $580. I think it's increased quite a bit lately.
$580, and that includes all product types.
Yeah, all product.
Single
types.
family, I think, is
$600s.
You can get a nice starter home in suburbia for $6. You could get a nice bungalow in an established neighborhood for I think still $6.
$50, yeah.
Our colleague Ryan's looking to buy an up-down duplex, which you'll be able to rent the basement for around $2,000, and you'll get that for $6.
So it's at least 50% more here, or 30% cheaper there.
Yeah.
And I will say, at your event on the weekend, there were a lot of people coming up and asked about Alberta and if they're too late to get into the market. which I found interesting.
And how did you answer that?
I said no. You got to think about the overall cost of a home there still. Now, do I think it's going to keep increasing? I'm not sure, but Calgary's just been such a hot market because of the low supply.
And the standard of living in Calgary, you love living out there?
Yeah. More space, easy to get to the mountains, just a high quality of living. I love coming here too. It's just totally different.
Well, our hockey team's better. So, if you want to see real hockey, you got to come out here now.
How long's the
I mean, we were at the game last night, so I don't
Yeah, that's true.
Oh, you're the reason we lost
there. Yeah, it could
Thanks,
be.
man. You're the reason we lost.
Apologies.
Yeah. Austin Matthews, he was averaging a hat trick a game until you guys showed up.
You ruined it.
Thank
I
you.
know. I was hoping for the third hat trick.
Oh, I know. That would have been historic. He was all over the net. I feel like he could have easily had a goal or two, but okay. And then...
Yeah, very affordable, easy to get around. Like infrastructure in terms of driving is very easy to bomb around Calgary, around Edmonton, to the mountains. We're about an hour away. A lot of tax advantages, personal income tax and corporate. It's not going to make or break a person, but
it matters. It matters when you're looking at affordability.
Are you seeing growth in areas like Red Deer because they're between Calgary and Edmonton? So people are going to Red Deer yet, or no?
We don't look at as closely as Red Deer because again, like we might have, I think right now we might have like 1 or 2% of our capital out in Red Deer. If that grew, we'd look more closely. But Red Deer is a hub for oil field services. So as the oil patch performs, so does Red Deer. But Red Deer is great too. It's an basically an hour and a half in between each of the big cities.
I was thinking if someone's thinking of Calgary, but Calgary's getting too big for them. Not that Calgary's too big, but if it is, then Red Deer is right there. You could be between Calgary and Edmonton, go to Red Deer.
It'd be more of an Airdrie or Okotoks.
Oh, yeah?
Those are probably the two spots outside of Calgary that people would live in and drive downtown.
Okay, and I'm putting you on the spot. Do you know the price of a single family home in one of those two communities? Ballpark.
Yeah, Airdrie probably in the 400s.
Yeah.
Okotoks maybe a little bit higher, 450.
What's traffic like getting to the city from there?
We're going back to our last conversation.
Yeah.
45 minutes.
Yeah, okay.
45.
I mean, yeah, it depends on traffic, but it's pretty reasonable.
Well, we just hired a gal that lives in Airdrie.
Yep.
And she's complaining about the commute. And I don't blame her because we don't, Calgarians, Albertans, anything more than half an hour is a commute. So I think it's like 45 minutes to an hour
on average
during rush hour traffic. So Airdrie would be a bedroom community to Calgary, maybe.
My God, that's a dream.
Like Airdrie is 10 minutes from the Calgary International Airport. So it's just north of. And less than an hour. And
we're an hour from Oakville to get to a Leaf game.
Yeah.
We're in an Airbnb right now on Queen and Spadina.
Okay.
We have to walk everywhere. Uber will take just as long.
You can't move.
Yeah.
It's crazy.
And so where are your other markets? You are in Ontario, Alberta. Do you do anything in British Columbia?
Nope.
Okay, so it's just Alberta and Ontario.
Correct.
Why is that?
We entered Ontario 3.5 years ago.
Oh, it's that recent.
Yeah.
Got it. Okay.
Yeah. And we're still operating in the relatively unknown. So as a lender, again, that risk thing, we need to know our markets intimately. We need to know our borrowers, our brokers intimately. And by rushing to expand to the next place, we're creating risk for us and in turn our shareholders, which we're not interested in. So we still see a long runway to growth in Ontario. Like, for example, we'll lend out more money this year in Alberta than in Ontario. And theoretically, when we, based off of population and average price of home, we should be lending out 8x in Ontario when we have it covered. That's not to say we're not going to go to BC until we have Ontario covered, but we need to take advantage of the opportunity we have here before we get into BC, and also we moved to Ontario to diversify from more of a one-trick pony economy, which is Alberta, and we have that here in Ontario. BC, from an economic diversity standpoint, doesn't really operate too different than Ontario.
Mm-hmm.
And you guys are raising capital from investors through your what is it? One fund? Multiple?
Yep.
I forget. It's one fund.
Yeah,
one
fund. We're unique in that it's one company, period.
Yeah.
We don't have a management company. All the money we earn flows into Calvert Home Mortgage Investment Corporation. We pay all expenses, and we push out our annual returns to our shareholders. We're a mix, so no retained earnings. We push out all our money to our sharedholders annually.
And the typical...
I was going to say, from your talk, our returns are above M2.
Well, that's great. I mean, like, all jokes aside, that like
we're happy with our money there.
Yeah, it has to be greater than like, it's like 7.5%, 8%. Like if you're not beating that rate, and that's
so
just,
true.
That's the minimum that we have to beat. What's a typical deal in Ontario look like for you guys right now? Somebody doing a burr, a flip. Can you just map it out?
Yeah.
Paint the picture. Where are they buying the home or the flip or whatever, the burr that they're doing?
It's all over Ontario, so there's not really a typical location. I would say like our most popular stuff is anywhere from London down to St. Catharines to up in Barrie even. Like there's different locations, but our typical deal will see someone putting anywhere from 20 grand down to purchase a property to 25% down. And our rates vary in between there. And usually someone will be doing a reno between 20 grand to 100 grand. Fix up the property and the loan will be on average on our books for about 8 months. And then they pay it out by selling it or refinance.
So they're giving you a business plan that says, hey, here's my plan to sell this thing within 8 months. And sorry, you said 20, as little as 20 grand. So what, you're lending the rest of the deal entirely if you put down 20 grand?
Yep.
But they're buying up something probably for $500,000 or $600,000.
Yeah, exactly. So as long as the purchase price is below 800,000, we'll consider a property and lending them up to purchase price minus 20 grand. So let's say we have a property that they want to buy that's worth 600,000. We'll consider lending them 580,000. And what they need to do is provide us with a detailed renovation budget and summary so that we can internally see what we think the as complete value is. So we have appraisers on staff. We have 4 appraisers, and then I'm obviously I hold my license with Rockstar. But it's really just for data. Like I'm not going to do any deals or anything, as you guys know, but we use it as data internally to see all the markets and understand what the market's doing, do our economic reports, and then do those values internally on an as-complete basis.
Well, it's so much easier when you can grab the data yourself. You just log in and get it.
And then your worst case scenario is somebody starts a project, they gut this house.
Yeah.
It goes belly up, they run out of money, and you guys then are comfortable moving in and having to sell this thing to recoup your loan. And if they put $20,000, so yeah, the rates have to be higher because you guys are taking on some risk.
Yeah.
But it's worked out.
Yeah, like that's so when we do lose, it's in those instances, but it's rare. So all of this is predicated on there being profit in the deal. And being profit in the deal is buying right? Like that is the key to managing our risk, is making sure that we're supporting a deal when the borrower's buying right. And in those instances, even when life happens to one of our borrowers and they don't complete, typically if they buy right, we can still sell it. We don't have to deal with finishing it. We could sell it, get out whole.
That'd be a nightmare.
Yeah, get out whole and move on. Through the downturn where the market basically corrected in the markets we're lending in, starting in March of last year through December, right? We had about a 20% price adjustment in the markets we're lending in. And typically when the market moves that steep, that quick in Alberta, we're going to take on some heavy losses, still being able to provide a positive return for our shareholders, but take on heavy losses. In Ontario, we got to go through that cycle, and it was versus historical in Alberta, well within range. Actually,
why was that?
Way
why
better.
Was that?
It was because in Ontario, so many people made so much wealth in real estate leading up to this that they can
absorb
it and move and live to fight another day. Whereas a lot of the real estate investors we're dealing with in Alberta, they haven't seen like that, those major appreciation events where they're really setting themselves up for long-term success. So we, most of the stuff that we lent on between that, like we look at the riskiest stuff on our books, the stuff that's been discounted the most within our portfolio would be the stuff we lent on from October of 21 through March of 22, right through peak. And we've cycled through most of it. Like we might have like 2 or 3% on our books right now that we've lent on from then.
Did you see any problems with even the people that were trying to, that weren't having, you guys didn't have to take back the property and deal with it? Were you guys seeing problems with appraisals at all with people at the end when they were trying to pay off the loans to you guys? Because if they're planning, because a lot of the investors you were dealing with, you said, were doing burrs.
Yep.
So I'd imagine there was some appraisal issues, right?
Yeah, and they just might have had to change their strategy. So they would have had to sell it if the appraisal wasn't coming in enough that the banks could take us out. But a lot of times they could figure out solutions and work with other people like mortgage brokers or whatnot to see what they could structure. And if they had other properties, they might be able to utilize some other equity to pay us off. So it's unique. And our two biggest underwriting criterias are they going to make money, like Jesse said? And two, do they have the money to do these projects? So up front, we're vetting them to make sure they have all the capital up front. Like, we're not taking into account, okay, you make a salary. We're not taking that into account. We want to see all the capital up front. And those issues that happened, a lot of them just took on so many projects at once and dug deep into debt, and it was difficult.
We saw that with some investors too, where they continued to buy properties, but not just that, they went back to their old properties and refinanced a bunch of those, and not even to buy other properties. They just took the cash out, and then when rates moved, they're like, hey, I'm in a pretty big negative cash flow situation now, but it's even though they had the properties for years, it's because they went back and then refinanced everything. They took a bunch of cash out. I'm like, well, you kind of can't have it both ways. Like, if you're taking out hundreds of thousands of dollars and rates move, you kind of got to expect to be in a negative situation, I think, at that point, right?
Yeah. We as Canadians are too debt ridden right now, and a lot of people just used their equity. We see that in Ontario a lot for a lifestyle.
But the incentive was there, right? Because when
rates are low, pull out 50 grand, pull out 100 grand, have a good time.
And because when the currency's that screwed up, and I don't know if you guys saw the chart that we put together. And I mean, it's not an exact science, but it was the M2 compared to the property prices, and in Ontario, right? Canada's M2 versus the average Toronto real estate board, and like the trend line, and that was only for like illustration purposes, because some people will pick it apart. They're like, well, it's not exact here, there, the trend line is so
there's a correlation for sure.
That housing, like if the incentive is to use housing as a financial instrument, is there. That's why people started doing it, right? It's like you've got to do something, because if you just let your money sit in the bank, you feel like you're flipping losing out.
Mm-hmm. Yep. But you got to protect yourself on the back.
Yeah,
totally.
100. Yeah, you can't go all.
Can't afford it.
It was too many at one time.
Yeah,
like it was too many eggs in one basket.
For sure.
That's why we always talk about. I don't know if you stuck around to the end, where we always talk about like 3 buckets. You have to have your liquidity bucket. You have to have your long-term savings. For us, that was gold before. Now I'm a big Bitcoin guy. Mm-hmm. And then you have to have your cash flow or income. So businesses, properties, whatever is going to generate some like ongoing cash flow for you. And I think when the real estate market was pumping really hard, when we had that first bucket of liquidity, and underneath I always wrote emergencies and deflation. No one ever asked about it. Like literally nobody ever. How many years did we have that slide up there? And no one's ever asked about it. Now everyone's like, how do you have liquidity, and how much liquidity should you have? And it's always interesting to me that it's at the time where you need it that people begin asking. Yeah. That's why I feel like saying now, no, it's like these 3 things should be at top of mind at all times. Like you want to be developing a long-term savings plan for yourself. You want to have immediate liquidity, and you want to have some assets over time as well. Mm-hmm. But it's a hard thing, I think, for people to do, because not many people have savings, and it's hard to just save money these days. And it's hard to qualify for a property. It's hard to start your own business. It's hard to build up some liquidity. So I kind of get it.
Yeah.
I didn't get to, I wanted to watch more of what you guys did on Saturday, because everyone who came out each time, they were saying how incredible each speaker was. Mm-hmm. So we caught the economic report, because we're like, everyone's like, that's what you come for too, is Tom's economic report. Mm-hmm. And it was so cool what you guys are doing and educating people, and having that kind of following. It was incredible.
We're just trying, you know what? When we got caught off, listen, our family almost bit the bullet financially in the 1990s. So when 2008 happened and we felt caught off guard again, even though Canada didn't get swiped too hard, we're like, what are we doing? We almost, financially got destroyed in the 90s. And now 2008 happens and we're not ready again. how does this work? And that began this deep dive of like, what are these central banks and what is money? How do interest rates work? And then it just scares the shit out of you because once you go down that rabbit hole, you're like, holy shit, what is this M2? We have to outpace this thing? How does this work? You know?
Well, you assume the people in control of it, you just naturally think they're like, oh, they must kind of know what they're doing. But then when you look into it, you're like, they don't know what the hell they're doing. They're just trying to figure it out as they go. So they know just as much as we do, right?
Yeah, it's a lot about financial literacy. Like you talk about why these people are up to what they're up to. It's a lack of financial literacy, and
it really is, and it's sad.
Yeah, it's such an important thing, yet for whatever reason, we're not treating it like the important thing that it is through our education system.
But do you think if we treat it like the important thing that it is, and so I don't mean like, you know, don't take on high interest debt and stuff, which is what you guys specialize in. But, you know, I mean long-term credit cards is for things that you don't really need.
Yes,
right?
yes.
So you don't, you know, there's that stuff. But do you think it would be valuable to talk about, hey, here's how kind of the money system works. These guys control it. There's this thing called inflation that like actually like, you know, how many years is it? 8 years to cut the value of something in half at a 2% inflation compounded? That's 8 years.
Rule of 72, yeah.
Or something like that, right? So a little longer.
We don't have the answer.
Okay, but anyways, but like if you think that like to teach people that, you know, what's the response to that going to be?
Is it going to be better than teaching them?
To not teaching them? Yeah, I mean, I think it creates a stronger society, but I just don't know.
Like, what are we learning? What are we learning in school today?
But yeah, at least
I don't know today, but from personal finance, I learned nothing.
Yeah. My wife is a teacher, so I get all the insight on this. And I ask, like, is there, and it's just to know the basics, then you can do the deeper dive and understand what you're talking about. But just basics. It's not even done in school at any time.
Well, the biggest scam to me seems to be like, yes, of course, Tom, you're going to lose money with your money. You have to invest it. And then if you invest it and you do something like the S&P 500, and then you divide the S&P 500 over the last 20 years by the money growth, M2, you realize it's up like 4%. So great. I invested my money for 20 years. The dollar number of it looked really great. But when the purchasing power gain was basically next to nothing, the whole thing's a joke. And then everyone's frustrated with each other, trying to figure out why no one's getting ahead, pointing fingers, blaming each other like that Spider-Man meme. You know that Spider-Man meme, pointing at each other, and no one's really getting to the source of the problem. It's kind of like, listen, there's two ways to do money. You can either have a commodity-based money or you can have a credit system. So we went down the credit system path. And then when you have a credit system, you kind of have a way to cheat on the credit system, because if we all lived in a small village together and I did you a favor by picking potatoes with you and helping you kind of do a harvest, you might say, oh, Tom, next time you have to take out the cows or whatever, I'm going to help you take out the cows. And we kind of just do this exchange, and mentally we just keep track of what we owe each other. But then as a village and a population grows, you can't do that anymore. So you need this kind of intermediary or this thing of trust, where in a credit-based system, that thing of trust became this like weird credit unit that was essentially the US Treasury, where these people on the side said, okay, you guys don't exchange things directly anymore. We on the side will create these credit units based on debt, and we give you a physical representation of that debt as $1. And then you can kind of start using these things as like credit receipts between each other, which is kind of sort of, I guess, possible, except the people on the side who are giving these credit receipts keep creating new ones and decreasing the value of the ones we exchange between each other. And the whole thing's a freaking scam.
Yeah. Well, it works until it doesn't, and then we just reset.
Yeah, it's that reset that's I'm curious for Calvert Mortgages, you guys with your crystal ball kind of analysis, because you have to do analysis. What do you think over the next year? What are we looking at? Like, you went to the mortgage, you were here checking out you're obviously data gathering yourselves.
Data gathering.
I will not hold you to any of this, but like in the next 12 months, what are you guys anticipating? Maybe, and I don't know if you break it out for Alberta, what you see, or Ontario, or Canada as a whole. So can you share some of that? What are you looking at?
Yeah. So what we're looking at is, in Ontario, and we try to be conservative with how we operate, because very rarely do we get punished for being conservative in terms of our projections. So we believe that, firstly, we're baking in 2 interest rate hikes now and again in the new year.
You are for Canada. That's your conservative.
That's our conservative point. Okay. So we do our financial modeling based off of that, and we also try to figure out how the real estate markets will respond based off of that.
Holy shit, off 2 more increases.
Because we still think we have an inflationary problem that we got to get solved. And as you've talked about, that's the central bankers are only concerned with predominantly concerned with solving inflation. So whether or not that happens, we'll see. But that's the approach we're taking. And in turn, we believe that Ontario will be in a slower state than you're used to, but not abnormal. Like, we're just not seeing massive price appreciation. Like, maybe we'll see most markets go into a buyer's market, which
I think
you guys haven't seen in 20 years. We see it all the time. Like, this is nothing new.
Yeah, we need it.
We need to get strong out here. We need to get strong out here.
Yeah. So in turn, maybe prices drop. And for us, with the short-term model, prices dropping 10% in 1 year doesn't scare us. Like, our investors can make a lot of money in that market, because what happens is they make money when they buy. They're buying opportunities. They can get actual discounts in properties, fix them up, bring them back to market, and make good money. So that's what we're anticipating for Ontario. High level. Like high level, we can win.
Sure.
We can win. Our borrowers can win. Our partners can win in that environment.
It actually brings back investing, because for so long, for so many years, or especially the last 3-4 years, everyone, it was just like, buy a property, any property. And this is where the problem comes in. So people were walking into sales offices and they're like, oh, I don't care. This thing hasn't closed for 4 or 5 years. Just give me 2, 3, whatever. I don't care. Here, the low down payment initially to lock up the unit and that type of thing. And now we're running into that situation where it's coming on closing. And it's like you said, it's when you're an investor that understands the market, you make money when you buy. And it brings back those opportunities for people to actually invest with, some fundamentals again, not really just looking at like, hey, it's going to go up, 20% a year, like just ridiculous numbers. They're just not sustainable at all.
Yeah, and we'll
talk to a lot of our experienced real estate investors in Alberta, and a lot of them don't like it the way it is right now. They're like, I can't do my due diligence on the property. I can't do.
Welcome to the club. Welcome to Ontario for the last 10 years. Yeah,
so it's like I don't have time to go through all my analysis and be able to really understand this property, what I need to do. So
we've been doing. I'll never forget. It was like 2012 or something. We were working with investors, and the market was it plateaued for a bit during 2008, just for a minute. It slowed, and you could do a little bit of analysis. And then the next 2 or 3 years, when rates were down, we were calling investors, and we would say, hey, we found this great property out in like Brantford or something. And they're like, great, I'll see it like on Thursday. Maybe we called them on Monday and we're like, no, you don't understand. We got to put in the offer today. Yeah. And like, well, what are you talking about? Like, we're like, no, it's going to go, And I think that's what you guys are now up against. As an investor, it's actually horrible.
Yes.
You don't have time.
Tough. Yeah. So the sharps will make money in a down, like the sharps love the downturn opportunities.
But we're seeing it now, because we're seeing some people pick up properties for whatever reason. They're decently priced. Their income, whether it's a 2, 3, 4 units, whatever it is, they're picking up these types of properties now. Numbers on them aren't great right now, but they're like, look, if rates go back to not even to where they were, to almost zero, but if they just kind of like go down a little bit, they're like, this thing could turn into like a really good property all of a sudden.
Yep.
So they're buying now with the expectation of like, in 1, 2, 3, 5 years, whatever it is, they're like, this thing's going to be good. And that's, so, versus having to compete in that market in 3-5 years from now, when again, you're just kind of trying to just get anything.
I'm happy you guys in Alberta are suffering like we've suffered for the years. Welcome to the investing club. If you had to break out the crystal ball again now for Alberta, because you gave us Ontario, what do you think Alberta looks like over the next little while, or what are you anticipating as a possibility?
So there's 2 very different markets, Calgary and Edmonton. Edmonton, again, well supplied. People are moving there, but not at the same velocity as Calgary.
What's the price difference?
I think it's about 10% different right now, maybe 15.
Yeah.
Okay. So between 10 and 15.
Yeah.
All right.
Yeah. But
which isn't huge.
Even more now.
Yeah.
Well, it could be more.
Because Calgary's been being pushed up from the numbers I'm seeing.
Calgary continues to be pushed up, whereas we've seen almost flattening, and in some instances,
I think it's closer to 20.
Decreasing. Yeah. Well,
So give us.
These are.
We just produced the economic report, but there's definitely a discount, and that discount is growing.
Okay.
But naturally, because Alberta has stronger wages, right? Like, we just make more money in Calgary than we do in Edmonton. So prices.
So give us your anticipation for or forecast for Calgary based on 2 rates in Canada, like you said.
So Calgary, we're just seeing so many people moving here. We're seeing so many jobs being filled up that we don't think we're going to see the appreciation we're seeing today, but certainly a stable market and a continued tight market because we're just undersupplied with housing.
But Calgary's already seeing the upper half of the market go not down, but it's not moving as much. But like the lower half in that 600 down,
sure,
it's moving
exploding
like crazy, and there's no supply. So people can't find a property right now.
What about I'm curious because I haven't followed it too much, and I know, a lot of Toronto investors, they look at Calgary, and then they, now there's some builders from here even building condos in Calgary, and I've just been interested. I'm like, are they forcing these projects into Calgary, and it's not a great fit for the community longer term? But it seems like they're getting absorbed, at least from the new sale perspective, because most of them that I know haven't been built, so I don't know like long term. But it's I'm just wondering what's that. I don't know if you guys know it because I know you don't play in that segment much, but
well. Garrett lived downtown. Yeah. I'm biased and really hopeful for our downtown core. We're bringing in a lot of young, talented, educated people who enjoy a downtown vibe. So I read a report, and I don't know how many tens of thousands, but it's not many, where we almost have the critical mass to have a vibrant, always continuous downtown.
Restaurants open late, stuff happening.
Like right now it shuts down unless there's something going on. Basically, we're building one of the biggest conference centers in North America will be finished very soon, which will be right beside our new $1 billion+ hockey rink.
You guys don't need that. You barely have a team, man.
So with that, I'm hopeful that we can create even further density in the downtown core, and even around the downtown core, our municipal leaders have opened up higher density for purpose-built rental stuff, and that CMLI product is helping and super profitable because of the current market rent. So I'm hopeful that the money being invested on high density, high rise stuff is worthwhile, but we've seen that like that's the stuff that just got smoked in 2007 and the downturn in 2014.
It's gonna be fascinating. If Calgary can get through a cycle where it doesn't get smoked, then Calgary has arrived. Right? I feel like if Calgary can get through that without that product getting smoked and any sort of plateau or slight more interest rate rise, I feel like Calgary
we've just been so flat for so long, so this is already a change for us.
Yeah.
It hasn't moved much. So you're saying Toronto people are building condos in Calgary, and is that like an anticipatory type of thing, like Ontario?
I get emails all the time from people saying, hey, here's the new Calgary development, buy this one. And it's Toronto. Well, I mean, these particular ones are Toronto.
And Toronto investors are so predisposed to buying pre-construction. They're like, I'll grab 2 of these condos in Calgary. And we're like, well, I don't know. I'd still rather, like, our whole thing has been buy resale. You know what you're getting. You know what the rates are. If you're going to go to Calgary, go buy a property where you know what it's going to rent for today. The pre-construction stuff.
We'll get questions on the pre-construction stuff where the developer will want a commitment letter in place before the client can even buy it.
They always want that.
And we're ridiculous. Like, well, we can give you something with every single condition that we have that we're going to redo everything when it's built. I don't know what the value is going to be in 3 years.
The developers always want that. Yeah, it makes no sense. Yeah. But because so we saw in the 90s in Mississauga, they had built a bunch of condos
around Square One,
right? And those condos, they got hit
smoked.
Hard. And they didn't come back for a long time.
10 years.
Yeah.
Wow.
Those ones, at least.
But on the development side, I think, like I said, I'm biased, but I think there's a really good chance. And that
would be cool.
You asked what we did while we were here on Friday. I spent most of my day on Bay Street with some of our lawyers, bankers.
That was a horrible day.
But more importantly, some family office clients who like really smart money that I get excited.
Oh, that's cool. Some good insights there.
Yeah, I get excited about listening to them and like what they're up to. It's always awesome insight. So we are hearing that some of those really sophisticated business people are looking for opportunities in Calgary. They're looking to partner. Like Calgary is, just like even downtown Toronto, in terms of the building, it's pretty incestuous, right? Like not many, it's hard to get in, and you want to usually to get in partner because smart money wants to partner with smart money at first to learn.
You want the local knowledge.
So I was hearing that in a real way, and they were big numbers and have done big things.
I believe
so.
it.
Calgary could be on the cusp here. This is a change, but I know we've said this about Calgary over the years, but this sounds interesting.
Yeah, but if you look at demographic trends, like in other countries and other areas, whenever there's affordability in one area, if there's another area that is attractive and has some other things, there is movement to that area, right?
It'll be if Calgary can keep the job growth going.
Can we keep the job growth? And again, I think it's about lifestyle. And I think I'm just picturing myself, like I graduated in 2007, lived in Ontario, was looking for an opportunity. And I saw it in Calgary, and I saw, and now like, okay, we got colder winters, but other than that, it's there. Like the weather, the economy, the
mountains,
you got the prairies, you got the it's all there. So I know, like, whenever I'm out and about and I get to meet young people who have moved to Calgary, I love to talk to them about why and how they're enjoying the city. And 8 times out of 10, they're loving it. They can't wait to build their future here. So I think that bodes well for our ability to keep and attract. And then you look at the employers, again, tax advantages. We got really inexpensive downtown office space. I think mostly everywhere does nowadays. So that's not as big of an advantage. But definitely, like, that flywheel, once it starts turning and people are coming here and companies are keeping their people because of the Calgary, the Alberta advantage, it's got a chance.
Yeah, it'll be interesting.
Canada almost needs it just to balance out, because right now it feels like, I mean, Quebec historically is just going to get what Quebec gets and attracts people. But let's face it, Ontario and British Columbia have been absorbing. I mean, Quebec gets a lot of.
Well, it's not Quebec gets Ontario and British Columbia.
It's Ontario.
It's Toronto.
Ontario's getting like 44% of immigration, and we both know a lot of immigrants who will come to Canada, land somewhere else, and then end up in Toronto.
Right.
So it's probably even more than 44% after 2 years of landing here in Canada or something like that. So, but it feels like, just to diversify the country, we need Calgary and Alberta to carry some weight.
This year's going to be interesting in Toronto, because what you guys were talking about within the condo market, and you're just wondering what might happen in Calgary from what you've seen in the past. In Toronto, with higher interest rates and higher costs now, or carrying costs, this year, I believe this is the record year for completions. If not, it's a very high number of units coming on the market from completions. And so far, it hasn't tanked the condo market. Now you're seeing inventory rise, 100%. Inventory starting to rise now, but not in like, maybe we need a few more months to see, but it's still not like a worrisome rise yet, but the trend's going up. So like it could be in a few months, I don't know. But with where the economy is right now, where interest rates are right now, for that much supply to come on the market, this would be a test for sure. Like, I think there's going to be a bit of an oversupply for a period. And we've seen this before. We saw it in 2020 when a slew of Airbnbs came on because of COVID. The listings from the condo market just jumped, and it took some time, right? I forget, it was probably 8 months or so, but it worked through it and kind of went back, right? So it'll be this one's different though, because of the interest rate. So it'll be interesting to watch.
So is that your main focus, is the GTA area?
No, and we don't even play in the condo market very much at all. No, but it's a lot of the activity is derived from what happens in that area. So even though we play in the kind of,
tertiary market, secondary
maybe, but even though we play in that, a lot of what happens, like in London, Ontario, is impacted by the GTA because of the affordability. Like, we've seen the London prices really start to move over the last few years once affordability really got out of whack in the GTA.
Yeah, London didn't appreciate it at all. We would tell people, hey, let's buy in London together for cash flow, but you're never going to appreciate it.
St.
And that story changed in the last 7 years.
Yeah, places like St. Catharines and Welland.
St. Catharines, Welland, Ontario. We're like, oh, okay, we can find cash flow out there, but just don't bank on any appreciation ever. That all went out the window.
But then it did, and then it went right back to near where it was, wasn't it?
What's that?
Those markets, they went way up.
We're talking a longer horizon.
Like 7 years.
Oh, no,
we're talking back then.
Yeah.
Like, if you look that far back, they're still
they're way
more than
up.
double.
They're way up.
They're more than
More than double.
Okay.
Yes, they're way up. Yeah. Tons of people out there who bought then just are sitting on tons of equity still.
They're probably still, I'd have to look at the numbers. I'm curious. I'd say over the last 4 years, so from like 2019, they're still up.
Oh, they're still up.
I bet you, I
so?
think from COVID, but from 2020, I probably would think they're still up as well, but not as much because they spiked like,
I know.
There was like the average there was a big chart that we had with all these different cities, and I swear like the appreciation numbers for a 2-year period were anywhere from about 35 to 50%. Like it was like.
Yeah, I would expect them to be up from 2019, not from like the second half of 2020 when the spike happened.
Not.
Right.
It might not be up from there.
Yeah.
But from 2019, I'm very confident they're up without looking at the numbers in front of me.
Yeah, 2019, I feel
for sure up. But from the spike of 2020, maybe not.
Yeah, like you think we saw that massive spike kind of August 21 through to the height of the market.
That was a ridiculous one. Yeah,
and then it came way off. But even that, like I would imagine most markets, say pre-August,
I think they're up
now are still up. Because
that's what I think. Yeah,
it went boom, boom.
Yeah, where you really got caught would be like 12 months ago or so.
Yeah, if you bought in January of 22, that's different. But
December, January, February, and then
in that time after Christmas, somebody came into our office. They're like, "Listen, I took Christmas off. I'm looking at prices. While I was gone in the last 3 weeks, did prices go up 30%?"
Really?
We were like, it looks like they did. And then the Bank of Canada came out and said, "We are not raising interest rates."
Oh, yeah,
we were looking at each other like, if you're not going to raise interest rates now, when are you going to? And then February, they quickly changed, But we were looking at the data on the streets. We're like, what are you guys talking about? You're not raising interest rates.
So I want to make sure, because you asked what we're doing, like the lending that we're doing in Ontario. And while we've had most of our success lending to real estate investors, we still love the short-term lending. So we call this, and we're seeing, because the investor sentiment, like again, the sharp money is up there gobbling up opportunities. But the less sophisticated, we'll call it, is kind of sitting on the sideline because they just hear, prices are going down, and they don't think that you can make money in a market like this. So we're doing actually less lending on that product type right now in Ontario, just because of the buyers. There's just simply not the buyers there, and but we call it interim purchases, and really it's just we're bridging a purchase. So sometimes this interim purchase will sell, sometimes they'll refinance. What we're seeing now is, okay, I bought a pre-con. I have real big money down. Maybe it's not up. Maybe it's flat. Maybe it's even down a bit, but I can't close because when I bought this thing, rates were at 2%. Today, I cannot close, but I don't want to lose. It doesn't make any sense to lose my deposit. I'll be net positive if I just buy this thing and sell. So we love those opportunities, and we'll lend on it fully open. If they pay us out in a month, they owe us 1 month interest. If they pay us out in 45 days interest. So we'll do a lot of that. We'll also do...
Oh, wow. I didn't know you were doing that.
We love that.
How are you ensuring they're going to sell it? Like, what if the person just decides not to list it?
Then we've already done our due diligence on the property and make sure that we're comfortable our mortgage against the asset.
Okay.
Yeah.
But when Garrett's underwriting it, he's going to interview them and like really
get to know them.
Yeah. Like, are you like, he knows all of our borrowers. He or his team will have a conversation with them and align, like, no, this is in your best interest.
Garrett has to smell bullshit, basically.
Yep. Yes, yeah.
But I remember that conversation from last time when we spoke. Like, it's actually really cool the way you guys do that, because it seems like just there's a sense of logic involved in the lending as well. You know, like you just kind of use, there's a little bit of thinking. It's not just black and white. There's kind of like, okay, let's kind of evaluate this a little bit more to kind of like what you were saying about like how Garrett, how you operate that.
We call every client. Like we're a relationship-based business, and we want to make sure that we're comfortable with these people. A lot of these people are coming back to us doing more. So we want to make sure that they understand us, we understand them, and then we also ask them if they have any questions for us. So we're a very different lender in that sense, that we're chatting with every single client of ours. Yeah.
And that really helps us if they run into trouble, because we've created a relationship, and hopefully that relationship will support our borrower to make better decisions in time of trouble. Like, where we see the worst happen is when they ignore it, they don't contact, because we have tools. We've been through cycles. We'll figure out solutions. Usually those solutions are in the best interest of both parties.
You guys have been in Alberta for 40 years, did you say?
Been lending it for 40. Yeah, 1981 was when the Mortgage Investment Corporation was founded.
Same type of model with short-term stuff?
For the last 30 years at least. So back then, most mortgage brokering was just done private. Like the banks would do bank business, and Everett, our founder, would mostly broker private business. And he ran into these two CFL football players for the Stampeders who invested in real estate, and they were crushing it. And he's like, man, this is an amazing model. Yet nobody wants to support it. So he really built that from that experience. And then through a lot of cycles, we've just refined it. So mid to lower half of the market, in larger markets, like we don't like small markets because there's less liquidity. When the tide goes out,
it sounds exactly like what we talk about.
When the tide goes out, those get hit the hardest.
So were you up in like the Fort McMurray areas during the last boom or anything like that? So that because I mean that was like the hot place.
The last boom, we probably had a bed.
So
when was that?
Depending on what you define the last boom at. So like 2007, 8 financial crisis, we had exposure. We had a little bit of exposure in like 11, 12, 13, 14. Yep. 14 energy prices peaked, and then just oversupply and OPEC issues. We had a little bit of exposure then. I think we have any exposure
I bet you we have like 3 loans out there.
So
like
even
either to sophisticated,
and they're probably really sharp loans, like 50% loan to value.
Were there other products that you have in Ontario? You mentioned that short-term lending product for pre-construction that people can't close, which is super interesting. I wasn't aware. Were you about to mention something else or no?
That's not even it's not even just for pre-construction. It could be banks say no last minute, and we'll pop in and say, hey, we'll do it right now, and you can get it refinanced and take more time, because sometimes it just takes.
How quick can you guys close?
We can close within 48 hours.
Oh wow!
In Ontario, we can close today in Alberta.
Wow!
Like literally pick up the money today.
So someone doesn't get their financing, you guys can come 48 hours in Ontario, same day in Alberta.
Yeah.
That last minute request from the bank when they changed their mind 24 hours before.
It's a nightmare.
I'm just like, what are you talking about?
Complete nightmare.
Why have we been discussing this for the last 3 months if you're going to do that? Like, this is ridiculous.
As you guys would probably know, a lot of these clients are bankable.
Yeah.
You look at all their financials.
Just one little detail change and the banks freak out because they don't have all the information. They don't fund.
Deposit hasn't been in the account for 90 days.
Yeah.
Your credit score is 640 rather than 650.
Yeah.
You moved jobs, better job, but you
added a supplementary credit card to your visa or something silly.
So it's just a little tweak, and then we understand that, and then we help fund them, and they fix that and refinance.
Yeah, we gobble up the stuff that is solid that falls off the bank's plate. That's
okay. So what else is that? Now have we covered it?
I'd say the one other big one is bridge deals, which we like to do too, where they have the purchase and sale on different dates, and they need to bridge that gap.
How long will you bridge for? What's your longest bridge? 30 days, 60 days?
I mean, all of our loans are short term. We'll bridge as short as 1 day, or it can go all the way to
8 months,
6 months.
Like when would when would you not consider it a bridge?
Well, to be a bridge, we're considering our bridge to be a firm sale. So if it's firm sold, I think I did one actually in Alberta that was 8 months.
Wow, that's unusual. That's a long close.
It was unusual, but it was like a developer buying some land.
Oh, got it.
Yeah.
But we were blanketing their home, so we were okay with that security. And the developer wanted to go through all his due diligence with purchase and whatnot.
You guys are really good guys to know. Now, you guys already knew that, but it's just becoming more and more clear to me. Like, you're really handy to have a connection at Calvert just in your back pocket.
Well, it's nice when you need someone to turn to, you know where to go.
Yeah.
Right? Just like anything else.
Well, how many times have you seen people freak out just because of that? Like, the banks change their mind on the day of closing.
That's happened to us before. I wanted to call the bank and just say, you know what? I'm just like, screw off. Like, I don't even want, like, I wish I could just do that and not have to deal with the repercussions. Cause I'm like, I don't care. I'll just get funding from somewhere else. Cause like, you're stupid.
Yeah.
You know,
and we don't want them long term, right? Like, this is just a solution to help them get into the property and then refinance.
So you don't
and
do
work with
any long-term financing?
No, not in Ontario.
Yeah.
Okay.
We have some stuff in Alberta, but it's rare because
it's not your bread and butter.
The bulk of our industry is built on that model, the long-term stuff. So, and they mostly compete on price. So why bother?
Yeah.
And
No, you
long
guys have
term,
found a nice niche.
to us, long term creates risk. Again, you guys have seen 20 years, 30 years of appreciation in Ontario. We see depreciation, and if it sits on our books, we're exposed to that.
Yeah, coming from Alberta, their mindset's so different because of the history of the real estate market, and the economy in Alberta is so up and down.
Yeah, but it's like there's market fluctuations over, especially over like a medium term. Whereas the short term, you can generally get an idea of where the market's going to be at. So it's actually kind of reduces risk in a way, because you're like, I see where the economy is. I can't guarantee, because anything can happen, but I can't guarantee where it's going to be in 8 months. But I got a rough idea of, six months out where I think things are going to be like. So you can kind of gauge things off there. It's actually,
And then relative to,
and it creates a lot of liquidity. So we're always prepared for opportunities, right? Like we're getting paid out, I think the last 2 months we got paid out on average 10% of our book per month. So we're getting $30 million
crazy.
back every month that we can recycle into the market, earn fees for our shareholders, support more borrowers.
it's always a problem. Then you got to find where to put that.
We're on a
money
treadmill.
back in. Yeah,
We're on a treadmill,
There's
but-
every business has it. Yeah.
Yeah.
But then, so what are the rates relative to whatever the best bank rate is at the current time? What would people listening to this think of, like for Calvert on short term? Is there like a range of rates? Or
Yeah,
is-
we have a range of rates, which ranges from 9.99, which is the product with the most down payment at 25%. And then we go all the way up to 18.24, which is the one we were talking about with 20 grand down.
Okay,
And
got
obviously
it.
that's our highest risk.
Got it.
But a lot of the guys doing those ones are either one of two things. They want to do a very quick flip, like just paint, clean out the garbage, relist it. So it's really only 2 months. And 18.24 annualized is not that expensive for 2 months. And then
that's a good point.
and then it's guys wanting to do multiple properties. So if they have capital and they want to take advantage of 2 properties at once and want to put little down, that can be an option for them to maximize profits.
And how are payments made with you guys?
Monthly interest
payments.
only, and then
Interest
our mortgages
only
are
monthly.
fully open, so they can pay us out as quick as they want.
Interest only monthly.
and you're less interested about debt ratios, more interested about assets, I'd imagine, right?
Yeah,
Capital available.
show us the money you have today to execute.
Yeah.
How liquid are you?
Yeah. So today prime is at 7.2. So our least expensive money is prime plus 2.5, which for an alternative lender is not bad.
Yeah.
It's important for the listeners too, when you're looking at private capital, look into fee structure. Like we're really fair on fees. So it's always 2%. In Ontario, whether you come through a broker or not. So
What's an example
so
of
do go out-
a bad fee structure?
Well, where it's just fee heavy. Like you see guys at 3, 4, 5, 6% fee.
6%?
Yeah.
Wow.
And then the borrower is looking, a lot of times the borrower unfortunately is just looking at the rate. Like I can show you a 2%
A great rate, but still
today
on a great borrower's fee.
Yeah. And then also we see a lot of additional fees. Like they'll charge a lawyer fee of $3,000. They'll charge a
Yeah, they nickel and dime everything.
like a discharge fee. So we avoid that. The fees that we charge are what you see on the paper, which is that 2%, and then you pay whatever the lawyer charges. We don't charge extra. There's no, you pay whatever the lawyer charges for discharge. So we try to be as transparent as possible as it relates to pricing.
And one of the ways that we are as fast as we say we are is because we do our internal values. And that's also a cost savings for the client because we don't charge for appraisals.
Because you are deciding.
We do them internally. Yeah.
In at the speed of business. So again, the investor that needs to close tomorrow, that's going to the top of our priority, getting done today, so that Garrett's team Garrett and our underwriters can commit today, instruct the lawyer.
That's wild.
We have a funding
That's wild.
team that are essentially a paralegal team. It's our mortgage instructions that go to the lawyer, whereas a lot of times in our industry, the lender will rely on the lawyer to draw everything up. So that moves things forward really quick. When there's a problem, they can deal with those problems. So yeah, it's just part of the business model, and it's about supporting real estate investors. Because when you go in to buy a property and you're solving the seller's problem of they need to get out from this now, then you could probably get a better deal if you're getting them out now, rather than waiting a week for an appraisal, 2 weeks for your lender. Mm-hmm. So yeah,
you guys have solved the inefficiency of private money, basically, because this has always been solved with like oh, do you know a guy who lends short term with private money? You guys have like made it an efficient model.
Well, yeah, if you can turn it around in same day to 48 hours, yeah.
Sounds like better fees, faster, more kind of professional.
There's a lot of private money in Ontario, a lot of private individuals, and I always want, if someone is going that way, and I'm okay with it, like if they decide, hey, like this is a better option, I ask them, hey, can I at least review the commitment letter? And
because you're going to see the fees.
Because I just want to see what, like if it's a good deal or not for them. Yeah.
We try to continue to solve the problem of mortgage lending. Like it's more than just alternative lending, because we see so many inefficiencies, so many box check underwriting where we're just looking to think outside that box and
it's pretty cool
and solve problems that the banks are willing to. And again, God bless the banks, because they create this model that's repeatable, easy. You could put...
That's being very kind of you, Jesse. No, I won't even give them that, but sure, you can.
You can put most anybody in that underwriting chair, you know. Listen, like
yeah, if I could create money from thin air when somebody signs a piece of paper and lend it out, I could probably make a profitable bank too. I mean, it's not that hard, let's face it. But yeah, you're a nice person. You're a nicer person than me, Jesse. But I feel really grateful to cross paths with you guys. Seriously, like this is really cool that we've crossed paths the way we have. I feel fortunate. Yeah. And then, so with the crystal ball, I guess one other question, how many years before Calgary wins the Stanley Cup will the Leafs win it? I figure 20 to 30 years. The Leafs will probably win it. Let's face it, we're winning this year or next year. That's a lock. Calgary's not going to win it for 20 to 30 years.
Let's bet the boys today.
Bet.
I think Calgary is going to do it before Trump.
Oh, that's done. What's the
odds?
What is the bet?
No, we won't even take odds. We're that crazy.
It's got to be a jersey swap of some sort.
Sure. Yeah,
jersey swap.
Done. You guys are going to regret this. For how long are you wearing the Leaf jersey when you wear this? Is it a day or 3 months? You have
to wear it to the next home game.
That's
with the other team.
Yeah, that's good.
Oh, that is bad.
That's good.
That's very bad.
That's a horror show.
This might never happen either. This might never happen.
Actually, that's
the next home game of the other team with like the four of us will go.
Yeah.
That'd be
good.
Okay.
So what is the deal? The home opener after you
we don't even know what the bet was.
So in Calgary, you guys will have to wear Leaf jerseys.
It's against the other team.
Yeah, it's got to be against the other team. Yeah. So when if Toronto's in Calgary or Calgary's,
we'll work out details after that.
Yeah, but yes, it's going to be horrible for you.
I'm with Garrett. I think the chances of either one of us winning are pretty slim.
No, we're winning it, and it's going to be soon. You guys are going to regret that.
We're in a bit of trouble.
And you know what? You guys are
he's very optimistic. I think
very optimistic, Jesse. That's very nice. You are a nice person.
We need some better draft picks. We always finish right in the middle, so we never get.
Well, if Edmonton had they had about, I don't know, what was it, 15 first picks or something.
Maybe you don't need to draft,
and they still can't win. Yeah,
that you don't need them.
Yeah, true enough.
They're like, did they win? No, what are they 0-2 right now?
And you take a McDavid away, and the rest of them,
and Draisaitl.
Yeah,
the best
superstars. They don't know how to play defense as a team.
No.
Not like
no depth.
Not like the Leafs know how to play.
Well, our defense is this year.
We have no defense. We have forwards playing defense. That's how.
No, we don't. But I wish we did. I told last night. I was like, why don't we just put four forwards on the
the new guy? What's his name? Killenberg. He looks like a forward. Yeah. Klingberg. What's his name?
Now you realize that Brody is a liability, huh?
Kind of, sort of. When he fell out the blue line there.
Yeah, but he wasn't for a while when he was here. He was decent.
I miss Muzzin.
Yeah,
but you got our former captain Gio.
I love Gio.
Solid, 40 years old, but he never makes a mistake.
I know, but he is 40 now. Like you saw last year,
I'm a fan.
He was solid for the first 3 quarters last year, and he's just falling off. And I'm a fan. I'm not trashing.
But hey, I love the Kadri.
Yeah.
He went through Colorado and picked up a cup to get there, so you can't really. I like Kadri. You know what? I'm actually a Kadri fan.
I do too.
The city likes him. You know,
I like Kadri.
He was bombing around Stampede. He seems like he.
I like Kadri.
He plays hard.
Yeah.
He plays hard. Anyone that has got some grit. This is my problem with
team guy.
Yeah, I'm a Kadri fan. I'm a Kadri fan. I'd take him back.
Nylander looks great because he skates really fast around the outside all the time. You know, but I like guys that have some grit. Will stand in front of the net and so it's just. That's why I think a lot of people would just migrate towards Kadri because he'll play like that. He's gritty.
Yeah, he does. That's a good bet.
We got Matthews. We're not giving you Matthews.
No.
Can't get him.
No.
All right, guys. So URL, how do people find you guys?
Yeah, our best way to find us is our website. Our website is geared specifically towards educating real estate investors. Our economic reports we give out for free. We have a flip analyzer that allows you. It's basically an automated spreadsheet. Has our cost baked in, spits out profitability. All you got to do is
great
enter.
that you've done that.
Yeah, enter basically purchase price, your rental costs, what you think the after repaired value is, and timeline, and boom, and it spits everything else out. So it's all about educating our borrowers to make better decisions to be more profitable. So just Google Calvert Home Mortgage. It's chmic.ca is our website. We have an awesome Instagram handle that's the exact same thing, based off education.
Okay, we'll link to both of those in the show notes of the podcast.
Yeah. And then you'll find Garrett and I's contact information. But Garrett's the guy you want to talk to. He's the underwriter. If you have any deals that short term that
he is the bullshit
He's
detector.
a smart guy.
him and his other, we got Garrett, Sherwin, and Rob, who are our senior underwriters. These guys are the best bullshit detectors in the industry.
Yeah. It's a tough role, man.
And
It's a tough role.
And then they're training and. But not only are they great bullshit detectors, they're amazing client service reps.
No, you could tell.
Yeah.
I
Then
can only
if you want to talk more about our fund, I was just going to say you can reach out to Jesse or I.
Okay.
On the investor side if they want to.
That's right. We didn't talk about that side. Sure.
Yeah, and we don't like
get
it.
into
We
it
got
much.
securities regulations.
Yeah.
We like
you gotta
to stay away. If you're interested in hearing more, reach out to Garrett or I. But yeah, Garrett, Rob, Sherwin manage a team of other underwriters. They're all great to talk to. They're all super knowledgeable, and looking forward to helping whoever with their next deal.
Very cool.
Thanks for stopping by, guys. Appreciate
Thank
this
you.
a lot.
Thanks.
Thanks.
Appreciate the relationship so much.
Thank you. Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.